Friday, September 12th, 2008, 6 p.m., Lower Manhattan. Treasury Secretary Henry Paulson summons the chief executives of every major Wall Street investment bank to the Federal Reserve Bank of New York. Goldman Sachs, Morgan Stanley, Merrill Lynch, JP Morgan Chase, Citigroup, they're given one weekend. By Sunday evening, before Asian markets open, they must arrange a private sector buyer for Lehman Brothers, the fourth largest investment bank in the United States, a firm founded in 1850 by a German immigrant in Montgomery, Alabama, a firm that survived the American Civil War, the Great Depression, 2 world wars. On Sunday evening, they leave the building with nothing. On Monday morning, Lehman Brothers files for bankruptcy, the largest bankruptcy in human history. 6 months before that weekend, the same room had hosted a different rescue. March 2008, Bear Stearns, 85 years old, fifth largest U.S. investment bank, collapsed over 9 days. Cash on hand dropped from $18 billion to $2 billion in 72 hours as hedge fund clients pulled their money and overnight repo counterparties refused to roll. The Federal Reserve, working through JP Morgan Chase, brokered an emergency sale at $2 per share, later raised to $10, with a $30 billion government backstop on Bear's worst mortgage assets. The message Wall Street took from the Bear Stearns rescue was simple. The Federal Reserve will not let a major investment bank fail. The reason was not generosity. The reason was systemic risk. Investment banks at this scale were so interconnected through the derivatives market and the repo market that any single failure threatened to cascade into every other major financial institution. Too big to fail. Lehman Brothers, by the summer of 2008, looked exactly like Bear Stearns 6 months earlier. The same heavy mortgage exposure, the same opaque balance sheet, the same dependence on overnight repo funding. Lehman's stock had fallen 73% year to date. Its credit default swap spreads had quadrupled. Hedge fund clients had begun pulling their prime brokerage balances at exactly the rate that killed Bear. By Friday, September 12th, the question on Wall Street was not whether Lehman would survive the weekend. The question was who would buy it and at what price. The bank that arrived at the Federal Reserve that Friday evening had been 158 years old. Henry Lehman, born Chaim Lehman in Bavaria, arrived in Montgomery, Alabama in 1844, 23 years old. He opened a dry goods store. By 1847, his brother Emanuel had joined the business. By 1850, their youngest brother Mayer arrived from Germany, and the firm took the name Lehman Brothers. What Lehman Brothers actually traded for the next 60 years was cotton. Alabama farmers paid for goods in raw cotton. The Lehmans accepted it, then resold it. Within a few years, the cotton trading was the business, and the dry goods store was a footnote. Henry died of yellow fever in 1855. His brothers built the cotton brokerage that became Lehman Brothers. By 1858, the center of cotton trading had moved from the South to New York City. Lehman moved with it, opened an office at 119 Liberty Street, a few blocks from where they would eventually file for bankruptcy. By 1865, founding member of the New York Cotton Exchange. By 1887, founding member of the New York Stock Exchange. In the early 20th century, Lehman financed the rise of the American consumer economy, underwrote the IPOs of Macy's, Sears, Woolworth, survived the 1929 crash, survived the Great Depression, survived 2 world wars. By the 1980s was acquired by Shearson and folded into American Express. In 1994, Lehman Brothers spun off as a standalone firm again. Its new chief executive officer was a man named Richard Fuld. Fuld had joined Lehman in 1969 as a commercial paper trader, 25 years on the trading floor before the corner office. Wall Street called him the gorilla, for his aggression, his height, and his willingness to humiliate subordinates in public. Under Fuld, between 1994 and 2007, Lehman Brothers became the most aggressive packager of mortgage-backed securities on Wall Street. By 2006, Lehman's 2 subprime lending arms, Aurora Loan Services and BNC Mortgage, were originating $50 billion in mortgage loans every single month, the 3rd largest mortgage originator in the country. By the end of fiscal year 2007, November 30th, 2007, Lehman Brothers held $111 billion in real estate-related assets and securities, more than double what it had held the year before. The leverage ratio, total assets divided by shareholder equity, had climbed from 24 to 1 in 2000 and 3 to 31 to 1 in 2007. This number is the core fact of the story. A leverage ratio of 31 to 1 means that for every dollar of shareholder equity, the firm controlled $31 of assets, which means a 3 or 4% decline in the value of those assets would entirely eliminate the firm's equity base, make the company technically insolvent. In late 2007, the value of Lehman's mortgage assets began declining by more than 3 or 4%. Lehman's chief financial officer, Aaron Callan, took the public position that the firm was healthy, that its mortgage exposure was hedged, that its leverage was within normal investment bank range. Her quarterly disclosures pointed to leverage ratios of 15, 16, 17, well below the 31 to 1 that the firm actually carried. She was reading from a script written by an accounting maneuver Lehman called Repo One-Oh-Five. The script worked because of a single technical loophole in U.S. accounting standards. Lehman had found it in 2001, classified the procedure as legal, signed off by their auditor Ernst & Young, and used it for 7 years. Repo One-Oh-Five worked like this: a repurchase agreement. A repo is a short-term loan. Lehman would sell securities to a counterparty for cash, with an agreement to buy them back a few days later at a slightly higher price. The slightly higher was the interest, standard Wall Street practice used for overnight liquidity. In a normal repo, Lehman sold securities at 100% of their cash value. The transaction stayed on Lehman's balance sheet as a financing debt because Lehman was contractually obligated to repurchase the securities. This is how repos, look on every other investment bank's books. Repo. 105 was different. Lehman sold securities at 105% of their cash value. That 5% over-collateralization triggered a specific accounting treatment under US GAAP Rule 140. The transaction was no longer classified as a financing. It was classified as a sale. A sale removes both the asset and the corresponding liability from the balance sheet for a few days. Then Lehman repurchased the securities and they came back on the balance sheet. Lehman ran Repo 105 at quarter end, specifically at the moments when Lehman had to publish its balance sheet to investors and regulators. In the second quarter of 2008 alone, Lehman moved $50 billion off the balance sheet via Repo 105. $50 billion of liabilities hidden from public view for the days that mattered. The reported leverage ratio in the first quarter of 2008, 15.4. The actual leverage ratio without Repo 105, 17.3. The internal nickname for the practice was window dressing. Lehman Brothers did not disclose Repo 105 to its government regulators, did not disclose it to the rating agencies, did not disclose it to its investors, did not disclose it to its own board of directors. In August 2008, the practice was about to be discovered. Quick break, Charting, sponsored by my own private community. I run depth case studies on financial system failures, the kind of multi-month forensics that won't fit into one episode. Repo 105 mechanics, compensation clawback structures, regulatory capture timelines, every Lehman document in the examiner's report cross-referenced to executive testimony, link in the description. Now, on Friday evening at the Federal Reserve. Friday, September 12th, 2008, 6 p.m. Federal Reserve Bank of New York. Henry Paulson, Treasury Secretary, former CEO of Goldman Sachs, had been calling Wall Street CEOs all afternoon. By 6, the boardroom on the third floor of 33 Liberty Street held nearly every major investment bank chief executive in the country. Lloyd Blankfein from Goldman, John Mack from Morgan Stanley, John Thain from Merrill Lynch, Jamie Dimon from JP Morgan, Vikram Pandit from Citigroup, Federal Reserve Chairman Ben Bernanke, joined by phone. Tim Geithner, president of the Federal Reserve Bank of New York, was in the room. Paulson's message was direct. There would be no public money for Lehman Brothers, no taxpayer-funded bailout. The room had to come up with a private sector solution. They had until Sunday night. 2 potential buyers had been identified. Bank of America, led by Ken Lewis and Barclays Capital, the British investment bank. Bank of America was the preferred buyer, larger balance sheet, American regulatory familiarity, already had retail banking infrastructure that could absorb Lehman's investment banking division. The deal contemplated would split Lehman in 2, a healthy operating business sold to Bank of America, and a bad bank containing Lehman's toxic real estate book funded by a $30 billion consortium of other Wall Street banks. Saturday, September 13th. Negotiations continued through the day. The Wall Street CEOs met in groups. Lawyers from Sullivan and Cromwell drafted term sheets. By Saturday evening, the Bank of America team had stopped returning calls. Sunday morning, September 14th, Bank of America announced the acquisition of Merrill Lynch instead. Ken Lewis had walked away from Lehman over the weekend and bought Merrill Lynch, the third largest investment bank with less toxic mortgage exposure than Lehman, at $50 billion. Barclays remained as the only buyer. Sunday afternoon, the United Kingdom's Financial Services Authority refused to fast-track Barclays' takeover approval. Specifically, the FSA refused to backstop Barclays' guarantee of Lehman's trades during the transition period. Without the guarantee, no British shareholder would approve. The deal required months of regulatory review that did not exist. By Sunday evening, the room knew. Hank Paulson, Ben Bernanke, and Tim Geithner, three of the four most powerful men in American financial regulation, informed Dick Fuld that there would be no rescue. The investment bank that had survived 158 years would file for bankruptcy in the morning. The fourth most powerful man was Federal Reserve Vice Chairman Donald Cohn. He had spent the weekend trying to find a different answer. There wasn't one. Monday, September 15th, 2008, 1:45 a.m. Eastern. Lehman Brothers Holdings, Inc. files for Chapter 11. Bankruptcy in the United States Bankruptcy Court for the Southern District of New York. $613 billion in debt, $639 billion in assets at filing, the largest bankruptcy in United States history. By the time the New York Stock Exchange opened that Monday morning at 9:30, the news had already broken globally. The Dow Jones Industrial Average fell 504 points, 4.4% by close, largest single-day drop since the September 11th terrorist attacks. $1,200 billion of U.S. market capitalization erased in one day. The cascade was immediate. Tuesday, September 16th, the Reserve Primary Money Market Fund, one of the oldest and most conservative funds in America, broke the buck. Net asset value fell below $1 per share, $785 million in losses on Lehman commercial paper. The first major money market fund to break the buck since 1994. Money market fund redemptions accelerated, $200 billion in withdrawals over 48 hours. The commercial paper market, the short-term funding mechanism for nearly every U.S. corporation, froze. Companies that had nothing to do with mortgages suddenly could not pay their employees, could not buy raw materials, could not finance their operations. That same Tuesday, the Federal Reserve loaned $85 billion to American International Group, AIG, in exchange for a 79.9% equity stake. The same government that 12 hours earlier refused to rescue Lehman now rescued AIG. The reason was that AIG's credit default swap exposure made its failure systemically more dangerous than Lehman's. The inconsistency was the moral hazard. Wednesday and Thursday, Treasury Secretary Paulson presented Congress a 3-page draft of what would become the $700 billion Troubled Asset Relief Program, the TARP. Congress rejected the first vote. The Dow dropped 778 points, 7% in one day. By the end of 2008, the global financial crisis had erased $7 trillion of market value, triggered 9 million American foreclosures, ended an era. Lehman Brothers had been 158 years old. 4 lessons, 3 of them unlearned. 1, too big to fail is not a rule. It is a decision made each time. Bear Stearns rescued, Lehman not, AIG rescued. The inconsistency was the policy error. Markets had priced in the rescue. Lehman demonstrated the rescue was conditional. AIG demonstrated the conditions were unpredictable. 2, balance sheets do not tell the truth at quarter end. Repo One-Oh-Five was technically legal under U.S. GAAP Rule 140. Ernst & Young signed off on the practice for 7 years. Lehman's investors, regulators, rating agencies, and own board did not know about it. The Anton Zambalka's examiner's report, in 2,200 pages, and established the practice in 2010. Dodd-Frank Section 855 descended directly from Repo One-Oh-Five. 3. Compensation persistence outlasts company collapse. Dick Fuld received $485 million in compensation. Between 1993 and 2007, approximately 70 to 75 million in cash, approximately 400 million in Lehman stock that became worthless on September 15th. The cash was paid over 14 years. The cash was kept. 4. No criminal charges. 12 Lehman executives received grand jury subpoenas in October 2008. The Department of Justice and the Securities and Exchange Commission concluded insufficient evidence to prove criminal intent beyond reasonable doubt, compared to the 1980 savings and loan crisis, which produced approximately 1,000 criminal convictions of bank executives. The Lehman generation produced 0. Friday, September 12th, 2008, 6 p.m., Lower Manhattan. The Treasury Secretary of the United States walked into a boardroom at the Federal Reserve Bank of New York, told Wall Street's most powerful men they had one weekend to save Lehman Brothers, and walked out 3 days later, having presided over the largest bankruptcy in human history. The bank that survived the Civil War, the Great Depression, and 2 world wars did not survive 72 hours. $613 billion in debt, 25,000 jobs erased, $7 trillion of global market value lost in the 4 weeks that followed, 9 million American foreclosures, the worst recession since 1929. Dick Fuld kept $75 million and was never criminally charged. The bank is gone. The lessons are still here. They have been here for 18 years. We continue to choose not to learn them.